Currency outflows from China are not letting up. $27.7 billion of yuan payments left China in August. Bloomberg says that this compares with an average monthly number of just $4.4 billion over the 5 years leading up to that point. Goldman Sachs says that these moves cannot be explained by market-driven factors alone, and indeed may even be worse. Add to this the recent data that showed China debt continues to climb to new record highs. Can China cope with all that's happening? Wei Li is head of investment strategy at EMEA, iShares, BlackRock, and joins us now. First of all, on the money flows, do we care? Should we care? Is it an issue?
I think it's very important, especially at times of volatility, to monitor the flow of capital, flow of money. And I think right now, compared to beginning of the year, this is less of an issue, because at the beginning of the year, you may remember there were lots of uncertainty around how they were managing currency, lots of uncertainty around kind of the growth outlook of the economy. And at that point, if you have significant capital outflow, that exacerbates the issue. So back then, if you look at this number compared to beginning of the year, this is a lot smaller. So I think there is a case to be made to put these numbers into perspective in terms of the averages, both over the last 5 years, which makes this number looks reasonably big, or over the last 12 months, which makes this number somewhat in line. So it matters a lot, but more so when markets are volatile.
What about the issue in the context of why it's happening? What is it that's stirring people to withdraw money? Why not keep it in there and reinvest it in the country? Surely that itself is a warning flag, isn't it, that people no longer want to invest in the country?
Think about it from the perspective of domestic investors. What can you stay invested in domestically? You can put it in property market, and so far we have seen a huge amount of increase, price appreciation, especially in the tier 1, tier 2 cities in China, and increasingly even in tier 3 cities. So many people have been looking at the incredible ascent of property prices in China over the last year to date as a bubble building up. So one could argue that that market is looking quite stretched in terms of valuation, which is why investors, domestic investors, have been more wary about putting money in the property sector. And if you think about stock market, yes, so far this year it starts to kind of find its footing from the correction at the beginning of the year, and starts to kind of slowly catch up, slowly rebound alongside a broader benign backdrop for emerging market asset return. But still, memories are reasonably fresh in terms of what happened last summer, the significant stock market correction. So I think some people are still reluctant to put money to work in the stock market as well. So that's another thing that could potentially tempt investors to put money overseas. And more broadly speaking, there is this expectation, and somewhat justified as well, that the Chinese currency is on a slow grinding lower trend, potentially depreciating gradually, slowly, which is what we have seen so far, versus the likes of dollar. And if that were to be the case, the sooner that you kind of convert it from their perspective, it may be profitable in that sense.
Yeah. Now, the point you mentioned about property is interesting. I mean, this takes us to some degree on the other aspect of what I wanted to talk about, the large debt pile. Of course, a lot of the property investments have been made up through debt. What about the increase in debt? My understanding is that the FT reported 2 weeks ago that this was now 237% of GDP, and we know that GDP is growing at about 5-6% plus in China. But worryingly, that's up from 148% of GDP in 2007. So we can see that this is accelerating at quite an alarming rate.
It's definitely alarming, both in terms of the pace at which it has been building up, but also the absolute level that it has reached so far, and on track to get even higher. One observation that I would make is that in China, a lot of the leverage, the debt pile, is happening in the private sector space. A lot of them have been accruing in the corporate space, and so far they have realized that is kind of where the leverage sits, where the problem sits. And as a result of that, they have actually been doing from the authorities' perspective, they have been trying to de-lever as much as they can without causing major problems in terms of systemic risk, and alongside that carry out kind of growth versus reform find rebalancing. So what they have been doing is, for example, this morning, they have announced measures to allow investors this debt for equity swap to bring down the leverage in the corporate structure. That is one move in the right direction. More drastic would be to allow companies that shouldn't survive, shouldn't sustain itself to go bankrupt. And so far this year, we have seen a significant, noticeable pickup in terms of the state-owned enterprise debt default. So we have seen that, and that is faster in terms of its efficacy in weeding out the zombie companies. But if it happens too much, then you have a sentiment scare. So they are trying to balance kind of how to slowly control the debt build up, but also at the same time not spook growth too much. They are aware of the problem.
So basically what you're saying is that the growth is contained within the country. It's domestically driven growth. Debt, I beg your pardon, is contained. So that unlike a Western type debt pile where there's a lot of contagion with other countries, presumably this won't ever actually affect other economies to the degree it might otherwise.
Well, the connection is less, exactly to your point, because most of the debt is held by domestic agents, domestic entities, which is why when you look at the significant debt build-up and you look at the same back in Asia crisis more than 15 years ago now, people look at the levels and they say, are we heading in the same kind of hard landing, bubble bursting direction? In our point of view, the fact that it's held by domestic agents definitely significantly alleviates the risk of that.
So as we look out to the next few quarters, China's not really on the horizon in terms of concerns.
So far, it went from a significant headwind earlier this year to somewhat gentle breezes and moderate tailwind. And as we go into next year, where we'll have significant leadership reshuffle, it is foreseeable that they would want to make sure that they are they would want to stay out of news where possible, and where they are in the news, they are in the news for the right reasons. So we could see a continuation of moderate stimulus coupled with gradual reform pace, and on the growth front, we're starting to see data stabilizing and pick up in some cases more than expected. For example, last month industrial production, last month's retail sales, last month fixed asset investment. So all of that are pointing in the right direction, and with the exception of, of course, there is the risk of policy error and miscommunication. But if we don't have that, we could see China actually becoming a supporter of broader sentiment towards emerging markets.
Good. Okay. Well, I'll look forward to more news as it comes through. Wei, in the meantime, thanks indeed for joining us. Wei Li is Head of Investment Strategy at EMEA iShares BlackRock.